Well, this week the lesson was the real safe haven is the US dollar and the highest quality bonds like 10 and 30-year Treasury bonds. These are the things that did well when Turkey started to melt down, and it still may melt down more. And why is that such a big deal? Because it's a symptom, as we've been saying, of the whole emerging world, which went on the biggest debt spree after 2008. The developed world went first, and then with low interest rates and US dollars and plentiful with all this money printing, it actually funneled into the emerging world, and they've gotten far into debt. So this is something to be worried about, and we'll see more of that. Now, just to remind people, some of the things we've been saying, gold. I got people out of gold and silver. The first big sell signal was in late April of 2011 at the day of the top on silver and several months before a slightly higher top in gold. It was the last of all the commodities to peak. But back just in early June 6th, I came out and I said, look, gold is testing an important support line, trending up, and it looks like it's going to break that. And if it does, this is going to be the last chance to get out of gold for people who keep holding on. And of course, gold's been down. That was at 1275, 1280. Now, gold just hit 1173 on Thursday. And it does look like it's going to go lower, even though it's extremely oversold. And ultimately, I'm saying gold, the most likely target is around $700, and then it may be one of the buys of a lifetime. We'll have to see when that time comes. It is possible on our bubble model that gold could go as low as $400 to $450, but I'm leaning less towards that because gold has held up better than most other bubbles. And believe me, we're looking at every bubble, and including cryptos. So gold has more to go, but it's really oversold and probably due for a bounce at some point. But I would say don't take that as a sign. And there's a lot of people thinking gold's getting ready to go up and then go to a whole new high. It doesn't look like that to us. And we've been right about this so far. Now, cryptos, I warned in December of 2017, just after the top, and when it was just starting to burst, I'm saying, you know what, the analogy here in Bitcoin and the cryptos, it's the internet stocks. In 1999, the internet's bubble was just a little over a year. It came at the end of a 6-year tech bubble, tech-driven bubble. It went up 6 to 8 times one year, and then it crashed 93%. When the internet, when the broader tech stocks went down 78%. So I'm saying that's the most likely scenario for Bitcoin. And now we said just in recent times that, it was back down testing. Bitcoin was testing the 5,800 level. And I said, this is a line in the sand. This is back to a number of lows it's made every time it's crashed. And if it breaks that, it's in trouble. At that time, I was saying, you know what? Gold is still not bouncing with this Turkey crisis, but the cryptos were bouncing up sharply. I said, maybe cryptos are replacing gold as the kind of safe haven assumption. But I had a caveat when I put out that notice weeks ago. I said, Bitcoin has got to convincingly break above 8,300 for this rally to be real. And you know what? It shot right up to there, went just over there for like an hour or something, went straight back down, and it's back near testing 5,800 again. So again, if Bitcoin follows that similar internet bubble, and remember, internet became a major sector after that bubble burst. That was just the first stage, and that was when internet was a concept. And most of those companies didn't have real business models and didn't have real earnings, and some of them didn't even have revenues. Well, that's the way Bitcoin and cryptos are now. They are nothing what they're going to be. Blockchain technologies, we said from the beginning, are a real long-term trend. It's like the internet too, but it's in its infancy, and this bubble does need to shake out. If it does follow the internet model over the next several months, it could be down as low as $1,000, give or take. So this is not a time to think, if a trader wants to buy Bitcoin here near this support level around 57.70 to be a little more exact, yeah, you may get a good bounce, but should everyday people be jumping in this? It's already proven to be the biggest bubble in history, the most volatile. This is not something to play with. Now again, why would gold go farther? and even maybe cryptos. Well, the dollar. We were warning recently that the dollar was looking like it was going to break out of a range it's in and go from 96 to 103. Well, it's already broken that level, already gone up to 97. If dollar keeps going up towards our targets, that's going to continue to be bad for gold. So even though gold and silver and all are really, really oversold short term, they could still go down further. So again, the safe haven in the winter season where deflation is the trend. And how do you know deflation is the trend even though we've only had a little bit of deflation and a good bit more in Japan? It's because governments are inflating frantically just to keep us at 0 to 2%. They're fighting deflation. That's the trend. In a deflationary environment, the strongest currencies like the US dollar, the reserve currency, and again, are we a great country doing all the right things? Of course we're not. We're printing money, we have too much debt, we're cutting taxes at a time we can't afford to, all this sort of stuff. But we're the best house in a bad neighborhood, and that's the way currencies trade. And Turkey just happens to be the worst house in the emerging world right now, and they won't end up being the worst before that's all over. So the US dollar and the highest quality bonds, AAA corporates, 10 and 30-year treasuries, these are the sectors that did the best. And throughout the whole decades of the 1930s, which was the most deflationary time in modern history, or at least since the late 1800s, so very long time. So that's where you go for safety. And of course, we have, and a lot of people just heard Adam O'Dell yesterday, we have a whole array of investment services that have one thing in common. They're not buy and hold anymore. That died in late 2007. At different risk levels, they can make money when markets are trending up and down. They're not committed to one direction or buy and hold, which is death, and will be for many, many years to come. So we have ways to make money on this, and we have. Our services have made money. A lot of people see me on the media and say, well, Harry, you keep warning about this bubble burst and it doesn't happen, so all your people are losing money. Well, some of them are, but not if they're looking at the real services we have to offer, and not if they've been even looking at our newsletter since Trump got elected. I said, look, you can't fight big tax cuts. That is a direct hit. Nothing more direct to help stocks. That's even better than quantitative easing gives. Really low interest rates, easy buybacks of stocks, easy leverage trading. You can't beat tax cuts. So we're still in that temporary trend. And I'll be talking more at IEFs. In late October. If you're ever going to catch one, catch this one about the two scenarios, and I'm going to be talking about it more in Boom and Bust, our flagship newsletter in September coming up. So this is a time to get serious. We are getting closer to a top. This is looking late stage, but there are two scenarios, and one of them could last well into 2019. And I think the next few months and some key indicators are going to tell us which of those scenarios more likely in the next 2 to 4 months. And so I will keep you updated.